So this is a review from federal income tax. In Tax 5015, the prerequisite is Tax 4001. Just because it's a prerequisite doesn't mean you need to know everything from Tax 4001. This video serves as a way to hone in on what you really do need to know. Now, I provided 3 documents in a review folder for you to look at. The first item is a general income tax questions checklist. So anytime you have a transaction, okay, in this course, you can always ask these 5 questions. It doesn't mean that you'll have an answer to all 5, but if you ask all 5 of these questions, you will cover all bases. So what amount is included in gross income? What amount is deductible? What is the character of the attribute? When is the amount included or deducted? And who must include, deduct, utilize the amount? So now I want to focus on a course packet that I made in my Tax 4001 course. It's called Journey in Federal Income Taxation. So Chapter 4 focuses on Introduction to Property Transactions. So the most important thing is that when you're determining income or loss for deduction purposes, you have to calculate the realized gain or loss. So I discuss how amount realized, the amount of realized gain or loss, the amount of recognized gain or loss, and the character. Okay, you might remember in Tax 4001 that the realization is the event that triggers the gross income, but recognition is what actually goes on the tax return. So recognition is the key event. Now, I'll discuss in a few minutes that recognition events sometimes they're not recognized for various reasons, okay? So this is really to focus on calculating the realized gain or loss. So the formula is going to be the amount realized minus the adjusted basis, and that gives you the realized gain or loss. And that's under Section 1001. Okay, Section 1001, determination of the amount of recognition of gain or loss. That is amount realized minus adjusted basis. So now we have to ask, what exactly is the amount realized? Okay, so here's that formula, amount realized minus adjusted basis under Section 1001A. So amount realized simply is actual cash received plus constructive cash received, which means relief of liabilities, plus the fair market value of non-cash property received minus any selling expenses. Now, when taking this into account, assumption of liabilities, whether it's taken subject to or assumption, meaning recourse or non-recourse, still has the same effect. It gets added to the amount realized. Again, as I mentioned, recognition is what we actually care about when we're looking at whether it goes on the tax return. So the next part of the formula is, what exactly is adjusted basis? So you might recall adjusted basis is this weird notion. It basically, in a theoretical standpoint, what it has to do with is we want to make sure that a taxpayer is not being taxed on previously taxed capital. That's what basis is. It keeps in mind that idea. Okay, if you have already been taxed on something, like whether you purchased it or whatnot, you shouldn't be taxed on it. It's your original investment on it. Okay, so Section 1011A states that adjusted basis is determined throughout the Internal Revenue Code and adjusted under Section 1016. So there's various basis rules, and you might recall some of those rules from your federal income tax class, like what is the basis rule for gifts, or what happens when somebody dies, and you inherit property, or what about if you receive property subject to divorce, a divorce proceeding. Well, the only one you really need to know about in this class is Section 1012, which says cost basis, which basically says that if you buy something, whatever you pay for the item, that is the cost basis. So if you pay $500 for your laptop, your basis in your laptop is $500. Now the rest of this chapter just provides the checklist. So I did provide checklists. So in this class, I have lots and lots of checklists. It's a great approach to tax because it puts everything together. So please go through these checklists. It goes to the formula, the 1001 formula, the amount realized I have defined. I have a little bit more in detail defining what fair market value is. I talk a little bit about this Philadelphia Park and Amusement case, which is an important case if you're talking about, you don't know how to value something and you can use the other side. Adjusted basis, I go in a little bit more depth and whatnot. So the other topic I want to consider, which is Chapter 6 in my Journey in Federal Income Taxation course packet, is the other part of property transactions, non-recognition and characterization. So as I mentioned, just because you have a realized gain or loss doesn't mean it's going to be recognized. Okay? Section 1001C says that all realized gains or losses are recognized unless otherwise provided in the Internal Revenue Code. Okay? So there's various provisions you might recall from Tax 4001 or your federal income tax course, okay? Maybe a like-kind exchange, which makes sense because if you are in a business and you have a truck, okay, and you exchange it for another truck that's extremely similar, economically, has anything really changed for you? No. And if you're trying to exchange a truck because for some reason, okay, it might affect your the efficiency of the transaction. It might create that it might stop you from doing the transaction, which again, in tax, we want taxes to be efficient, meaning it doesn't have an effect on these kind of things. Okay? It doesn't have an effect on your behavior. So non-recognition events are all about liquidity, number one, and number two, you're in the same economic boat. Okay? Now, we're going to learn about a lot of non-recognition transactions in this course. Okay, starting with corporations at the beginning. So you just have to know the general concepts. You don't have to remember like-kind. You don't have to remember involuntary conversions and other rules you might have learned. Okay, so I go through and I talk about why I have non-recognition rules. Again, there's some general themes dealing with liquidity and dealing with the same economic situation. All right, so the next topic is characterization. So you might recall that characterization has to do with, okay, once you determine if you have a gain or loss, you have to determine what is the character of that gain or loss. It could be ordinary, it could be capital, it could be Section 1231, which might result in something different. You might have to recapture something like Section 1245. Okay? Characterization is ultimately what are the consequences in the end with respect to a gain or loss. Now, it's important because there's preferential treatment with respect to certain things, specifically long-term capital gains. Long-term capital gains historically have always had better treatment than ordinary income, okay? Now, the historical rate for long-term capital gains has been around 28%, okay? Versus ordinary income rates have been as high as 95%. So if you're back in the 1960s when the ordinary income rate can get up to the high 80% and you are in a high bracket, you want to try to get that long-term capital gain rate because it's at 28%. That's how people did it back then, okay? And still today, we still have benefits for long-term capital gains. I mean, it's obviously, not the difference that 90-28 is not there. There's not much of a high of a difference anymore, but it's still, there still is a difference, okay? Generally speaking, if a taxpayer has a gain, the taxpayer wants long-term capital gain. If a taxpayer has a loss, they want ordinary loss. And the reason is because capital losses are severely limited, okay? And also, if you have an ordinary loss, there's a good chance you're going to be able to offset that ordinary income with that, which gives it a higher percentage in the ordinary income bracket, okay? Capital losses can offset capital gains, okay? First, a long-term capital loss offsets long-term capital gain. Then, a long-term capital loss can offset short-term capital gain. And then finally, up to $3,000 of ordinary income. And the same is true for short-term capital losses. Can offset long-term capital losses, then, can offset short-term capital losses first, then long-term capital losses, then $3,000. Now, if you have a long-term capital loss and a short-term capital loss, and you get to that $3,000, you can only use $3,000 total for the year. If you have a short-term capital loss and a long-term capital loss, the short-term capital loss is the one that reduces the $3,000 first, because because the short-term generally has a better benefit in a way. Okay, and that's what the rule is. Okay, so in order to determine whether something is long-term capital gain or capital in nature, we should say first, or 1231, we got to go through some items first. We got to go through some determinations. The first thing is that section 1221 defines a capital asset, and it actually defines it very interesting. It says that all assets are capital assets unless provided here, and it lays out some different types. Now, I've only provided 5 here, 5 different types. There's actually 9, 10 different types, but these are the main 5, okay? So the first is inventory. Number 2 and number 3 are personal. Number 2 is personal property used in trade or business that's subject to depreciation or amortization. And number 3 is any real property used in trade or business. Okay? So that captures a lot of the assets out there in the market. Number 4 is an interesting one. It's basically copyrights that are created by the individual. So if you buy the copyright, no, that's a capital asset. But if you create the copyright, it is not a capital asset. And finally, the last one's accounts receivable or notes receivable. So these items are not considered capital assets under section 1221. So if you have a capital asset under section 1221, the next step is you need to determine whether you have a sale or exchange. Okay? If you have a sale or exchange, then you can get sale or exchange treatment, and then that will give you capital gain, potentially capital gain treatment. If you don't have a sale or exchange, you can't get the preferential capital gain treatment. It just will be ordinary in nature. Okay? So short-term versus long-term. Long-term is anything more than a year when you hold it for longer than a year. Short-term is a year or less. Holding period. Okay? Holding period is section 1223. Holding period basically deals with how long you've held an item. Okay? We start counting the day after you acquire something. Now, can you tack? Tacking means can you add on a person, another person's holding period, or if you substitute, or if you had another item and you're carrying it over or whatnot, the basis. And it really depends. It depends. In this class, we're going to learn different types of holding period rules, and you're going to see it's going to be important. So just make sure you always pay attention to that. Okay? It always is going to be important. Okay? So if you have a capital asset, you have a sale or exchange, and it's held for more than a year, looking at holding period, then you have a long-term capital gain or capital loss. But if it's a year or less, it's short-term capital gain or short-term capital loss. If you don't have sale or exchange, it can't be capital. If it's not a capital asset, it could be capital if it's 1231, but if it's not 1231, it's going to be ordinary. Okay? Which again, ordinary is bad. Okay? So section 1231 is probably the most beneficial code section in the Internal Revenue Code for taxpayers. It's called taxpayer nirvana because as I mentioned earlier, when you have a gain or income, you want long-term capital gain. If you have a loss, you want ordinary loss. And that's exactly what 1231 does. Because 1231, going back to 1221, is number 2 and number 3 on our list. Personal property used in trade or business, that's subject to depreciation and amortization, and then real property used in trade or business. Any, doesn't have to be depreciable, so it can be land. It has to be held for more than a year. More than a year. And basically, if you have that, you have 1231. Now, 1231 has 2 hodgepots, a sub-hodgepot, main hodgepot. In this class, you only need to worry about the main hodgepot. The main hodgepot says that we take all the 1231 items that are classified as 1231. If it nets as a gain, then everything is considered long-term capital. That's the gains and losses. But if it nets in a loss, then everything is considered ordinary. That paragraph right there says it. Okay? This defines what a 1231 asset is. Again, it's number 2 and number 3 in the 1221 and held for more than a year. Okay. Now, it's possible to get 1231 treatment, just so you know, under the sub-hodgepot, even if you're non-business. But you don't have to worry about that in this class, because in this class, we're going to be trade or business. Okay. You're not really going to see too much investment in this class. It's going to be trade or business. All right. So now, we're not going to talk about the sub-hodgepot. You can skip that. Now I want to go to recapture. So the idea of recapture is that you got a benefit in 1 year, okay, that resulted in ordinary. But when you sell the item, it would result in 1231 or capital. That is a mismatch. one of the themes in tax is matching. If you got an ordinary deduction, you should have to recoup ordinary income. And that's exactly what Section 1245 deals with. Section 1245 deals with recapture of depreciable property. That's all depreciable property. By the way, 1245 also applies to amortization. Even though it says depreciation, there's a special provision in Section 197F that says that where it says depreciation in the code, you have to always consider amortization as well. So it also applies to amortization, okay? So 1245 applies to depreciable property that was used in trade or business or investment. So it's basically anytime any property was ever depreciable. If you sell it and it's 1231 or it's capital, you have to recapture the lesser of the realized gain, okay? You have to recapture the lesser of, and that's what this computation is here. The lesser of the realized gain or the amount of depreciation, whichever is lesser. Okay, and that amount will be considered ordinary income. Now, this trumps all other code sections, except, it does. It trumps all other code sections unless otherwise provided. You're going to see that when we do some provisions, non-recognition provisions later, that the non-recognition provisions will trump. But 1245 is what we call strong arm language. It's a gotcha rule. It basically takes over everything. Okay, so that's really how recapture works. But whatever is left, whatever is not considered ordinary under the recapture is considered the capital or the 1231, whatever it was originally characterized as. All right, just so you know. Note that if it's a loss, if it's lost property, meaning that it results in a loss, you can't have 1245 recapture. It only applies to gains. It only applies to gains. All right, so that's really everything in this chapter. Now, at the end of this, I have a checklist. Again, the best way to learn tax, to see how everything's connected, is to go through checklists. So I create a checklist for you. Please go over that as well as this part if you need to review these concepts. If what I'm saying to you is foreign, you really need to read through this again. So I look forward to seeing you in the next video.